One file, one spreadsheet, one decision made in silence. While global markets appeared calm, a document escaped a vault that was never meant to be opened. Not a rumor, not an analyst model, not a speculative theory. A real internal spreadsheet leaked quietly by someone who understood exactly what it meant if the numbers ever became public. This was not activism, it was panic. The file contained no opinions, no commentary, no narrative, just rows and columns, client accounts, claimed ounces, allocated metal, unallocated exposure. When those numbers were added together, the silver market stopped making sense. Tens of billions of ounces promised, only a microscopic fraction physically deliverable. For decades, the system worked because almost no one asked for the metal. Paper claims were easier, cash settlement was faster. Trust filled the gap between promises and reality. This document proved that gap had become an abyss. What makes this leak different from every previous warning is simple. This is not estimation. It is internal accounting. Actual balances, actual inventories, actual leverage ratios, no assumptions required. The math speaks for itself. When a fractional system depends on belief, exposure is fatal. Once the evidence exists, behavior changes. And when behavior changes, price is forced to follow. This is not about whether silver should rise. It is about whether a structure built on extreme leverage can survive once its own numbers are revealed. In the chapters ahead, I will show you exactly how deep that leverage goes, why previous estimates were conservative, and why the outcome is no longer debatable. This is not fear, it is not hype. It is arithmetic. To understand why this leak is so dangerous, you have to understand what the spreadsheet actually represents. Not headlines, not interpretations, the structure. Because once you see how the system is built, the outcome becomes obvious. Each row in the document represents a client relationship, not a trade, not a position, a promise, a claim on silver that the bank acknowledged as real. Each column shows how that promise is categorized: allocated metal, unallocated exposure, derivative obligations, and internal offsets designed to make the totals appear balanced. On paper, it looks orderly, professional, controlled. But when you aggregate the data, something extraordinary happens. The claimed ounces grow exponentially while the physical inventory barely moves. This is not leverage in the traditional sense. This is multiplication without restraint. Allocated silver is simple. Specific bars, serial numbers, segregated ownership. That metal cannot be touched, lent, or reused. It exists outside the game. The problem is everything else. Unallocated accounts, pooled claims, derivative contracts that promise exposure without delivery. These instruments are stacked, reused, and rehypothecated until the original ounce becomes unrecognizable. The spreadsheet shows that most clients believe they own silver, but legally they own a claim. A claim that only works if almost no one exercises it. The moment multiple parties ask the same question at the same time, "Where is my metal?" the illusion breaks. What makes this document lethal is not one bad ratio. It is the layering, claims on claims, promises backed by other promises. Physical metal counted multiple times because accounting rules allow it. Risk dispersed so widely that no single desk appears exposed while the system as a whole is dangerously fragile. This is why past warnings failed. Analysts suspected leverage, traders sensed imbalance, but suspicion does not change behavior. Proof does. Once internal numbers exist outside controlled channels, trust evaporates instantly. This chapter is not about scandal. It is about mechanics. And once you understand the mechanics, you realize the system does not fail gradually. It fails suddenly. The most dangerous leverage is the kind no one can see. Not because it is hidden, but because it is normalized. Over time, repetition turns risk into routine. What begins as an exception becomes standard practice. And eventually, no one remembers what the system looks like without it. In the silver market, leverage did not explode overnight. It accumulated quietly. Each unallocated account made sense in isolation. Each derivative contract appeared manageable on its own. Each lease was justified as temporary, reversible, low risk. But the spreadsheet shows what happens when all of those reasonable decisions are combined. The same ounce is promised multiple times because the rules allow it. An ounce can back an unallocated claim, be referenced in a derivative, be leased to a third party, and still appear on a balance sheet as available. On paper, nothing looks wrong. In reality, the metal can only exist in one place at one time. This is how leverage becomes invisible. No single desk sees the full picture. Risk is fragmented across departments, products, and counterparties. Accountability dissolves. What remains is a system that functions only if demand stays passive and synchronized behavior never occurs. But markets do not stay passive forever. They shift when incentives change, when information change, when participants stop assuming and start verifying. The spreadsheet does not accuse anyone. It does not need to. It simply reveals how far the system drifted from physical reality. At extreme leverage, stability becomes binary. Either almost no one asks for delivery or the system fails. There is no middle ground, no gradual adjustment, no controlled unwind. Once confidence cracks, everyone moves at once. This is the point where leverage stops being a tool and becomes a trigger. Not for volatility alone, but for repricing. Because price is the only mechanism left that can restore balance when promises exceed supply. And once that process begins, it does not ask for permission. Every leverage system survives on one unspoken assumption: delivery will never be tested at scale. Models assume rolling contracts, cash settlement, and cooperative behavior. They do not model panic. They do not model verification. And they certainly do not model millions of participants reaching the same conclusion at the same time. The spreadsheet exposes why delivery was never meant to happen. Physical silver inside the system is not idle. It is encumbered, lent out, pledged, reused, counted, then counted again. By the time obligations are netted, only a thin layer of metal remains truly available. Everything else is already spoken for, even if the accounting suggests otherwise. This is where theory collides with reality. A claim does not become dangerous until someone insists on fulfillment. The moment that happens, the system must choose deliver metal or settle in cash. Under normal conditions, cash settlement is accepted. Under stress, it is rejected. That is when price stops being a quote and becomes a rationing mechanism. Most models assume delivery demand stays below a critical threshold. Historically, it did. Investors preferred exposure. Industrial users relied on long-term contracts. Speculators rolled positions forward. The spreadsheet shows how dependent the system became on that behavior, continuing indefinitely. But once a small percentage of participants shift from exposure to ownership, the math breaks. Delivery requests compound. Queues form. Delays appear. Language changes. Phrases like subject to availability replace certainty, and trust evaporates faster than liquidity. At that point, the system has only one lever left: price. Price must rise high enough to discourage delivery, to force some participants to accept cash, to restore balance through voluntary surrender. This is not market speculation. It is mechanical necessity. The spreadsheet proves that delivery was never a feature. It was a liability. And once that liability is recognized, the countdown begins. Markets do not break because of numbers alone. They break because people react to numbers. The spreadsheet did not remove silver from vaults. It removed belief from the system. And belief is what allowed extreme leverage to exist in the first place. For years, holding paper exposure made sense. It was liquid. It was efficient. It felt equivalent to ownership because no one tested the difference. But once evidence appears showing that ownership and exposure are not the same, behavior shifts rapidly. And behavior, not opinion, moves markets. The first reaction is not panic. It is verification. Calls to account representatives. Requests to convert unallocated positions into allocated metal. Quiet inquiries that signal rising stress. When those requests are delayed, denied, or redirected, suspicion turns into urgency. Urgency spreads. What begins with institutional players quickly reaches funds, then retail investors. Each group watches the others. When one moves, the rest follow. This is how delivery demand jumps from negligible to destabilizing without warning. At that point, price is no longer discovered. It is imposed. The market must rise until enough participants decide that exposure is preferable to ownership again. That decision is not emotional, it is financial. price must reach a level where surrender becomes rational. This is why repricing events feel violent. They are not gradual adjustments, they are forced recalibrations. The spreadsheet accelerates that process by removing uncertainty. Once the scale of leverage is known, hesitation disappears. What follows is not chaos, but compression. Time collapses. Decisions that would normally unfold over years happen in days. Systems designed for stability suddenly operate at emergency speed. Price does not lead this process, it follows it, and once behavior flips, price has no choice but to chase reality. When behavior shifts, emotion steps aside and mathematics takes control. At extreme leverage, debate ends. The system must clear, and only two mechanisms exist: delivery or repricing. When delivery is structurally impossible, repricing is not optional. A fractional market survives only while fulfillment demand remains microscopic. At thousands to one, leverage, even a modest rise in delivery requests, creates an immediate and unfillable shortfall. This is not stress. This is mechanical failure. No reassurance, no policy statement, no liquidity operation can change arithmetic. At this stage, price stops reflecting sentiment and starts enforcing decisions. It becomes a sorting mechanism. It rises until only those who genuinely require the metal remain. Everyone else is forced to choose exposure or exit. That separation is how balance is restored when supply cannot expand. Industrial demand is rigid. Manufacturers cannot substitute contracts for material or pause production indefinitely. Financial demand is flexible. It can liquidate, accept cash, or retreat. The reset depends entirely on that imbalance. Price must rise high enough to push flexible demand out of the system. This is why forced repricings always look irrational beforehand. They are not designed to be fair or gradual. They are designed to be decisive. Once uncertainty disappears, hesitation vanishes. Participants act early, compressing time and accelerating the move. From this point, slow adjustment is impossible. The system jumps toward equilibrium, overshoots, and stabilizes only after surrender occurs. This is not speculation. It is how constrained systems behave when exposed. When a system is exposed, time compresses. Processes designed to unfold over years are forced into days. The spreadsheet did not introduce a new problem. It removed the delay that kept the old one hidden. Before exposure, participants wait for confirmation. After exposure, they rush to be early. No one wants to be last in a queue that may never move. That shift alone accelerates the reset faster than any external shock ever could. The first phase is quiet repositioning. Large holders attempt to convert claims into something more secure. They do not announce it. They test the system. When those tests encounter friction, word spreads quickly through professional networks. Liquidity vanishes before headlines appear. Next comes feedback. Price rises not because of optimism, but because sellers disappear. Physical holders step back, recognizing scarcity. Buyers become urgent. Each transaction resets expectations higher. This creates vertical moves that feel disconnected from fundamentals, even though fundamentals are driving everything. Meanwhile, paper markets begin to fracture. Discounts appear, settlement terms change, timelines stretch. Each small adjustment confirms the same message: delivery is constrained. Confidence erodes in real time. Once this phase begins, intervention becomes ineffective. Raising margins, adjusting rules, issuing statements. These actions signal stress rather than strength. Participants interpret them correctly as attempts to buy time. And when markets sense delay, they accelerate. This is why resets do not arrive gradually. They arrive as cascades. One decision triggers another. One delay triggers a rush. One revelation removes the last reason to wait. Speed is not a feature of panic. It is the natural consequence of certainty. Once speed enters the system, order breaks along a predictable fault line: paper versus physical. Claims that once traded interchangeably begin to diverge in value, and that divergence widens faster than most participants expect. The first exits come from those who understand structure. They do not wait for peak prices. They do not try to time headlines. They reduce exposure immediately, accepting imperfect exits in exchange for certainty. This creates selling pressure in paper markets even as physical demand explodes. As paper holders rush to exit, spreads appear. Cash settlements replace delivery. Discounts to underlying value widen. What once looked like silver starts trading like risk. The instruments have not changed, the perception has. At the same time, physical markets experience the opposite dynamic. Sellers step away. Inventory disappears. Premiums detach from quoted prices. Transactions become negotiated local and uneven. Geography starts to matter. Form starts to matter. Availability becomes the only metric that counts. This is the moment most observers misinterpret. They see falling paper prices and assume the move is over. In reality, the system is splitting. Paper is clearing through surrender. Physical is repricing through scarcity. The gap between the two is not an anomaly. It is the mechanism. Paper must cheapen enough to convince holders to exit without delivery. Physical must rise high enough to ration what remains. Both processes happen simultaneously, reinforcing each other. Once this divergence becomes visible, reversal is impossible. The market has chosen its path. All that remains is for price to finish the work. After the split between paper and physical becomes undeniable, the market enters its most misunderstood phase. This is where volatility remains high. Headlines stay loud, and yet the outcome is already constrained. From here forward, price is no longer searching. It is converging. Clearing does not happen when panic peaks. It happens after surrender. Paper claims exit through discounts, cash settlement, and forced liquidation. Each exit reduces pressure on physical delivery, narrowing the set of participants who truly require metal. At the same time, elevated prices begin to change behavior on the supply side. Physical holders who waited through the initial surge start to sell selectively, not because they doubt the thesis, but because price finally compensates for scarcity. Profits become real. Risk becomes worth reducing. This selling does not collapse the market. It stabilizes it. Industrial buyers remain, but they adapt. Some redesign products. Some lock in forward contracts. Some delay marginal demand. This is demand destruction, not fear-based, but economic. It is necessary for balance to return. What emerges from this process is not a top, but a plateau. Transactions cluster around a range where enough physical is offered and enough demand remains. Volatility compresses, liquidity returns unevenly. The market stops reacting to news and starts responding to availability. This is the point where observers mistake calm for resolution. In reality, the reset has already occurred. The excess has been purged. What remains is a new structure built around fewer claims, higher prices, and a clearer distinction between ownership and exposure. Clearing is not dramatic. It is definitive. Every market crisis teaches the same lesson, but only a few people learn it while it still matters. Systems do not fail because prices are wrong. They fail because structure is ignored. This event was never about silver alone. It was about leveraged trust and the difference between owning something and believing you own it. The spreadsheet did not create risk. It revealed it, and once revealed, the outcome followed a path that was never negotiable. Excess claims were eliminated, weak hands exited, price rose not as a reward but as a corrective force. The market did not become irrational, it became honest. The strategic takeaway is simple but uncomfortable in moments of structural stress. Liquidity is not safety and exposure is not ownership. Instruments designed for convenience fail first. Assets grounded in physical reality endure, but only for those who understand timing, patience, and discipline. This is why the most important decisions are made before headlines peak and after panic subsides. Chasing emotion destroys capital. Understanding structure preserves it. The investors who survive these events are not the loudest or the fastest. They are the ones who know what they actually hold. Going forward, markets will rebuild. They always do. But they rebuild around new assumptions, fewer promises, and higher prices that reflect real constraints. Those who adapt early gain flexibility. Those who wait are forced to react. This is not about predicting the next move. It is about recognizing how systems behave when exposed and positioning yourself accordingly, calmly, deliberately, and without illusion. If this analysis helped you see the market differently, make sure you subscribe, like, and share this video so others can think clearly instead of reacting emotionally. And comment structure if you want deeper breakdowns like this in the future episodes. Understanding markets is not about being right once. It is about surviving long enough to be right again.